because what are the fundamentals of Bitcoin? There's no cash flow. There's no earnings, right? So like the traditional value investor is like, what the hell is this thing? It's just a liquidity gauge. And then I would say, yeah, it is a liquidity gauge. Exactly. Right. And it's just marginal buyers and marginal sellers that's any asset. It's just flows. And here we have an absolutely scarce thing.
All right, everyone. Welcome back to another episode of On the Margin. Today, I'm joined by Dylan LeClair, who's a senior analyst at Bitcoin Magazine, and Will Clemente, who's the co-founder at Reflexivity Research. Fellas, welcome to the show.
Michael, excited to chat. This is going to be a fun one.
Thanks for having us on. I'm excited to see Dylan as well.
Same, man. I'm excited to do this episode. You guys are two of the sharpest minds in the space, but also what interests me about your guys' interests is there's kind of this intersection of everything that's going on in macro, but you also get very deep on the crypto and Bitcoin side of things. So I thought we could have a fun conversation, kind of doing a review of some of the big macro trends. And Will, I know you put out a big report. We'll link it in the show notes here. But basically just sum up what are some of the big macro trends in 2022? How do you see that translating into 2023? And then we'll talk about like where and how that intersects with crypto, Bitcoin, all that sort of fun stuff. So maybe I could just, I'll just open this up to the two of you. Could start from 10,000 feet. If I had to ask you guys to describe like what were some of the big macro themes that we saw in 2022, how would you kind of describe the last year from that perspective?
Sure, yeah. I guess I can give it a rip first, and then turn it over to Will. I think 2022, if we're looking back at a 10,000 foot view, it was obviously the fastest tightening cycle in history, and at least modern history. If we're looking at it from a Bitcoin crypto specific lens, it kind of coincided with this absolute purge of both transparent and obfuscated leverage, right? We kind of all knew that there was, this growing and expanding leverage futures derivatives market. What wasn't known going in, or not wasn't known, but what market participants found out was that there was a whole bunch of hidden leverage that wasn't transparent, whether that was in the form of, leveraged altcoin tokens like FTT or, like Luna, that kind of added like $50 billion of market cap. And while bonds and equities were selling off, Bitcoin was, pumping from 32K after the Ukraine invasion to 45, 48K, something like that. Right. So there was kind of that momentary period of like decoupling that was really just like funny money leverage. So I think the good news, the silver lining of like Bitcoin being down 65% in 2022 is like we purged a whole lot of leverage, ASIC collateralized leverage, futures leverage, altcoin leverage, right? So like in terms of like the gross forced selling, it's going to be real tough to see that replicate again in 2023. Marginal sellers can obviously persist if we go into an economic recession, but I think it's a real healthy cleanse. And this is something that Bitcoin does, like market cycle to market cycle. You kind of see just, once the tide goes out, a lot of bodies wash ashore. And so, going into 2023, I don't think there's a return into, an up only everything bubble market again. But the good news is, the speculators, a lot of the leverage, and a lot of like the hype and the stories that people told have been kind of like, that's a lot been washed. So really the only people that are in the market today holding and buying are the people that like actually, for the most part understand this thing, or at least, have a ton of conviction. So I think that's where I get really excited going forward.
Yeah, I think that Dylan hit on basically everything. I think the one thing that maybe you didn't touch on was Bitcoin miners. We've entered a, second capitulatory period over the last few months, seen a tremendous amount of forced selling as we saw over summer earlier this year. It was interesting, we kind of entered this period in June where we saw a lot of forced selling for miners. We saw Core Scientific, for example, sell about $170 million of BTC. And then we saw a very large increase in hash rate, which was quite surprising given kind of the broader context of it just being such a bad time to get involved in mining unless you have, just absolutely dirt cheap energy costs. But nonetheless, we saw a slight rebound in hash rate. And then about a month ago, according to an indicator called Hash Ribbons, we re-entered another minor capitulatory period. We've seen pretty heavy selling, at least looking at some of the on-chain data that Dylan and I look at. But interestingly enough, over the last week, we've finally seen kind of what we look at as the net position change, which is the 30-day change in the Bitcoin miners holdings. That's finally flipped green. So I completely agree with Dylan's assessment that I think for the vast majority of the market, a lot of the forced selling has already taken place, at least for Bitcoin.
So for crypto overall, like if we had to rewind the clock, right, and take a look at the catalyst, this was sort of the first, 2022 was sort of the first year, for better or worse, largely worse, right, where we found out that crypto was really trading based on the macro cycle, right? So all of this sort of started with central banks tightening, right? They started to raise rates, which obviously hit risk assets. At the same time as rates went up, liquidity flowed into the dollar, right? So the DXY kind of went on this huge bull run, which also killed risk assets. And then we saw, I think, the greatest contraction in liquidity as measured by M2 supply in the past. You can go charts back to the 1700s, back to basically the founding of America. So there's this huge sort of macro overhang. I'd be curious to get your sense before we get like too into the weeds of everything going on in crypto. Like, do you see those trends continuing in 2023? Do you see some element of mean reversion? I'd like to get a sense if we're heading into an environment of headwinds or tailwinds.
I think the big question is, in terms of the rate of velocity of rate hikes, I think that's in the past. I think the big question now is how long is the Fed going to hold rates, at the terminal rate? And so, I think we're looking at maybe potentially another, 25 bips or maybe another, second 25 bip raise after that. But in terms of kind of the, rate of increases Dylan talked about, when you look at the velocity of rate hikes, this, current tightening cycle is on par with the highest that we've ever seen historically, only kind of challenged by that of the 1980s. And so I think for a lot of market participants, it's kind of up in the air in terms of, the Fed looking at their dot plot saying that they're going to hold rates, at these levels for the end of the year. I think, a lot of the, questions around, are these rate hikes and the lagging effect of these rate hikes finally going to start to seek into the, broader economy over the next few months? I think that's kind of, something that we'll probably likely see, heading into the next 2 quarters.
Yeah, I kind of agree there. In terms of the strengthening dollar, whether the Dixie goes lower in the next day, week, month, I don't see the catalyst there for, sustained dollar weakness over a prolonged period of time. Like structurally, when I look at the dollar, like everybody, including myself, right? Like everybody talks about how bad of a situation the U.S. is in terms of a debt position. And, a lot of talk in 2021 was like, the Fed is trapped, right? They can't raise or meaningfully raise for a long period of time. And I somewhat agree there, even though they have raised to, 400 bips. We might get a terminal rate over 5%. Higher for longer seems to be the trend. And surprisingly, like the thing that maybe surprised me the most was once it was clear that, okay, inflation is absolutely ripping. It's not coming down. And central banks around the globe are going to go from uber dovish to uber hawkish. My surprise was that, okay, things didn't break. And actually, the economy, at least nominally, is pretty resilient for the moment. But when I think of like, okay, what's the Dixie, right? It's a basket of the euro, the yen, the pound, right? Like, and if you tell me, and here I kind of agree with Brent Johnson, right? Who has a different kind of conclusion to the thesis of like, he's not a Bitcoin bull necessarily, but dollars and gold, right? Well, why? Because you're measuring dollars and gold against the Eurozone, which is, there's a lot of structural problems there. Debt burdens are worse. Demographics are worse. There's an energy shortage. The same situation in the UK, and same with the yen, right? Like the Bank of Japan is embarking upon yield curve control. So like, I mean, I'm a dollar bull here. I've like, have small short positions across, a basket of those currencies. But I think for risk assets, like that's, potentially the 10 trillion, $100 trillion question is like, what's a dollar short squeeze look like? If we see a sustained period of time above 5%, right? This economy is going from, say, a deceleration to, do we see an outright contraction? And I think that's what we potentially might see in 2023 or beyond, right? We just have this massive global dollar short position. And if things start to slow down, if the music starts to stop, this game of musical chairs, which is a debt-based economy, right? Then I think we might see some, maybe, potentially unforeseen consequences in the sense of, everything sells off, dollar bids. So I don't think that happens tomorrow or next week or maybe even necessarily this quarter or this year, right? But structurally, nothing has changed in the sense of we have a massive debt problem, and it's not just a domestic U.S. Dollar problem. It's globally, right? And so if the U.S. economy enters recession, then the world economy enters recession, and then things start to get real interesting. So I think this, central banks, the Fed being trapped is kind of like this mantra in 2021. I think it's still true, and I don't think they can have the Fed funds at 5% for like far too long. But I think they can do it for a time, right? And ultimately, the result will be pain. So I think we are in for a little bit more pain from a general macro perspective. We're starting to see the last parts of the business cycle turn, like employment. I think that's probably the next leg to go. We've seen it mostly in like white collar jobs so far, but I think that the housing and employment cycle are probably two of the things that turn next. And I think that will have to be met eventually with an easing cycle. But we're obviously don't want to put the cart before the horse.
Yeah, I think I just to add on top of that, I think also when you look at the Dixie, traditionally crypto is kind of traded with this almost direct inverse correlation with the Dixie. I think as you have central banks around the world outside of the Fed continuing to raise rates, and as you just mentioned, the Fed's kind of surpassed their peak velocity of rate hikes. I think just because potentially on a relative basis the dollar's weakening in this basket of other currencies, maybe on a short to medium term basis, I don't necessarily think that means that it's bullish for risk assets such as crypto, just because it's not the dollar weakening as much as it's just other central banks around the world tightening to catch up to the Fed. And I think to Dylan's point, I think you hit the nail on the head. I think also one thing I would watch out for that our macro guy has kind of been drilling into our clients' brains is keep an eye on inflation in Japan. I think that could be kind of the final straw to break the back of the horse. If you finally have Japan stepping off their yield curve control because inflation gets out of hand in 2023, I think that's a potential catalyst to watch out for the remainder of the year.
And just to plug your macro guy there, well, that's a guy named Felix Joven. He actually did an interview with my colleague Jack Farley on Forward Guidance, which is an interview highly worth checking out. Would you actually mind describing, without getting too much in the weeds of what's going on with the BOJ, why is that such an important thing to watch? Why is inflation in Japan potentially sort of a black swan or potential disruptor?
I would just say because the Bank of Japan is really the only central bank that's still kind of holding on to this previous monetary regime. And so I would say, if inflation becomes entrenched into the Japanese economy, that could become an issue for the final I guess central bank that's holding on to easy monetary policy. And I think that could be potentially something that creates the final leg down that people like Dylan have been talking about for a while in macro.
Yeah, I've got one more sort of macro line of questioning. Sorry, Dylan, did you want to respond to that?
Well, yeah, I would just add that the dynamic with Japan and like the Eurozone as well, when you're just thinking about what's the dollar trading against and the world's other biggest bond markets. One thing that I think it's a little hard to communicate is that sovereign debt, like why would Japan matter for U.S. financial markets? Like when the Bank of Japan came in and went from 25 bip yield curve control to 50 bips, like why did global bonds sell off? And it's because sovereign debt as an asset class is fungible on an FX hedged basis, right? So there's currency swap markets, right? And so when rates say if they abandon their yield curve control policy, which I don't think they can meaningfully do, given debt to GDP is like 250, 260%, they're purposely trying to erode real debt burdens with this policy. But they have a ton of ammunition. They have $1 trillion in FX reserves, so they can it's kind of there's almost a circular logic where they're conducting yield curve control while also intervening in the FX market to kind of stem speculators shorting the yen. So, I mean, they can play the game for a while, but it's interesting, if they did, say abandon it, temporarily, or again, like kind of move from 50 bips to 100 bips or whatever for their 10-year peg. It would be interesting to see kind of the global bond market reaction, because that policy is one of the things that are keeping global sovereign bond yields not pinned, but lower than they would be, right? Because they're easing, and on an FX hedge basis, sovereign debt as an asset is fungible.
So that's an interesting dynamic that you're starting to hit there. Let me ask you, because a lot of governments seem like they're trying to, to borrow an expression, to ride two horses with one ass, right? In that they're trying to protect both their currency markets and the market for sovereign bonds, right? So that works as long as you're not in an environment of inflation. But as soon as you have to make your yields on your bonds basically match what's going on with inflation, then it's very difficult, right? The only way to basically do that and maintain whatever yield you need to be able to service the debt, you need to basically, the government or central bank or whatever it is needs to become the buyer of those bonds, which automatically debases the currency. So we had Brent on here a couple of weeks ago, basically talking about this decision that governments are going to have to make around the world, either to save their currency markets or their bond markets in general. Do either of you guys have an opinion on, is this the year that governments are going to have to make that decision ultimately? Do you have a sense of which way they would, or which way do you think they would ultimately lean? How do you guys view sort of the push-pull in between those two markets?
I think that the U.S. is weaponizing the dollar to an extent, right? We kind of have this geopolitical war going on. China is like weaponizing supply chains with their zero COVID policy. I mean, no one really knows what's going on in China. It's kind of a black box with Xi's policies, but the zero COVID policies are certainly kind of wreaking some havoc on supply chains. Russia is weaponizing energy and their commodities, and the U.S. is or really G7 with Russia and whatnot. They weaponized their currencies, but really the dollar as this global reserve currency. And if we do get a period of higher for longer, the U.S. can kind of bankrupt the world, right? And like the Luke Roman thesis of the Treasury, the Treasury will go bankrupt essentially if we have rates this long. Well, the Treasury is the last to go bankrupt. The world goes bankrupt first. So I think that's the real interesting thing, is that we can almost, if we just look at like geopolitical strategy, we don't know what they're thinking, right? But one of the things that would really hurt the U.S.'s enemies and allies alike is an extremely strong dollar. But it would almost we're exporting our inflation to the world. And then, if the world does, if we do bankrupt the world, who's the first to touch, if you think about the Cantillon effect, who's the first to kind of get that access to new dollars if the Fed does monetize debt again, right? If they do, because say the Fed's choosing, or the Fed U.S. government is choosing the currency instead of the bond market, right? Well, if they, instead decide, okay, we'll lay off the gas a little bit, we'll weaken the dollar and we'll kind of intervene in the bond market again. Well, if the world is so-called bankrupted by these policies, well, the U.S. kind of gets that fresh influx of cash and can almost, buy up the world per se. And I know that's like kind of hyperbolic, but I think that's partially what's going on. I think this is a distinct policy decision. And it's one that's obviously very, very effective, right? So U.S. markets are obviously hurting a bit, and bondholders have been hurt because of the duration move, and stocks have gone down 20%. But I think the U.S. is like many people say, kind of the cleanest of the dirty shirts. So it'll be really interesting to see how long they can play the game.
I've got just one more sort of line of questioning as it relates to macro, and then we can sort of get into the intersection of crypto and macro. But, one other thing that's important to pay attention to, I think, and I know this was highlighted, Will, in your report, was just liquidity. And there are a couple of different things to pay attention to there. So there's the reverse repo facility. There's the TGA, which is the Treasury General Account. And then there's the Fed's balance sheet. So when we kind of look into this year, it's hard to get sort of a gauge on liquidity, because you still have a whole bunch of assets that are sitting. I think it's about $2 trillion that's sitting in reverse repo, which if that were to flow out into the economy, that's very bullish liquidity. At the same time, QT, which is the Fed has been telegraphing for a long period of time, is like finally starting to take effect. And then the TGA, I'll be honest, I just don't really know how to forecast that. And that swings pretty wildly around, to be honest. So there's sort of these like factors, these big components of liquidity, they're sort of bouncing up against each other. Do you guys have like a sense or framework internally about how you think about liquidity conditions? And if so, like, again, headwind, tailwind going into this year, do you think?
Yeah, I would just say, in the report, we included this chart, which exactly how you described. We looked at the Fed balance sheet, reverse repo, and then TGA accounts. And so I'd say, if we go back to the beginning of the beginning of last year, it's crazy to think that the Fed was still doing QE in January of last year. But at the same time, we did start to see, liquidity flow out into the reverse repo facility. And so that's been something that I personally been watching very closely, and we've been talking about a lot in reports that we send out to clients is, when you watch reverse repo flows, you've seen the markets pretty closely correlated with that over the last year or so.
Yeah, I think Darius Dale came up with the net liquidity kind of function of, okay, everybody's looking at the Fed balance sheet, but once like the Fed, they're doing $120 billion of printing debt monetization a month, they stuffed so much liquidity into the system The banks were so flush with reserves, they didn't know what to do. They didn't know what to do with all that money. And so all of a sudden you see reverse repo go from $0, not even being utilized at the beginning of 2021 to skyrocketing up to, 1 trillion. Now it's sitting at $2 trillion of just basically just, excess liquidity just being parked in this. So I think it's really interesting to kind of monitor. If you just like chart the SPX and you overlay it with the Fed balance sheet and then you kind of subtract the excess liquidity parked in the reverse repo, and then also, account for the Treasury General account drawing down, you get a really interesting correlation there. And I think that's kind of a not a primary driver, but certainly maybe a primary driver of markets, right? Like the whole game, everyone kind of knew the game, whether it was crypto, S&P 500, like anything that, post COVID, the game was liquidity. Don't fight the Fed. They're pumping money. And now, the Fed's like, all right, guys, like not the gig is up, but temporarily the gig is up, right? We're gonna, money printer go burr. Now it's like almost a money vacuum, right? So we're sucking up all that liquidity, and market participants are kind of, you see them back and forth seesaw, like fighting the Fed. And then, Jerome Powell comes out, Jackson Hole, and he's like, no, guys, like literally sell your stocks, and the markets tank again. And it's kind of like, it's just like back and forth. And so I honestly think the Fed has done a really, I got to give them credit. They've done a good job of like a controlled drawdown, right? Like the VIX has gone above 40, right? So like every time things get oversold, every time, there's somewhat of a panic in markets and volatility explodes, they walk out, daily in the Fed speakers and they're like, all right, guys, like Bullard comes out and he's like, all right, like maybe we'll ease off and markets rip. And so it's like this really interesting like seesaw effect. And I'm not sure when it exactly ends, but I don't think the gig, the gig or the game is up yet. Right. I still think there's some more pain to go and some more excess liquidity in the system. So we'll see. But, really like all the speculative names, if you look at all of the best performers in 2020 and 2021, look what they did in 2022. They all got killed. It wasn't even about the names or the story or the narrative. It was a liquidity game. And so I think that's still the driver.
I think also when you look at a bunch of different, correlations to BTC and ETH or even like the broader crypto market cap, when you look at the correlation to that, liquidity, net liquidity index that Darius Dale kind of coined as you described, after 2020, we really started to see that correlation really ramp up, at least with Bitcoin and ETH. Whereas, some of the two other biggest are just looking at M2 money supply and the Dixie, which Bitcoin and ETH have basically been inversely correlated to for all of their history. But looking at that net liquidity index after 2020, you really started to see a complete, correlation with that kind of trading in lockstep. And so I think that just kind of highlights how, as Travis Kling likes to say, everything is one trade, and it's basically all about liquidity for the last 2 years.
Yeah, maybe now we can kind of transition into crypto because there are these great charts that you can find around, but where you can sort of matches up some measure of liquidity. I'm not sure if it was Darius's or whatever, but you can look at liquidity, dollar liquidity in the S&P, and it tracks basically perfectly. And you sort of have in front of that perfect correlation, you've got kind of this combination of Bitcoin and crypto almost front running expectations of liquidity. And that relationship was pretty solid for the last couple of years. And I know some people, I'd love to get your opinion on like whether or not you guys think that's a good thing, right? For a long period of time, Bitcoin was seen as this uncorrelated asset class. That was a big selling point, big part of the narrative. I'm not as convinced personally that it's a bad thing that, crypto like fits now within an allocation framework for global investors. But that relationship was certainly there. We've in my view, we've kind of seen that break down in the past couple months, and really honestly, post Terra Luna, we've decoupled lower, which in some senses isn't great, right? We've got the fundamentals in our industry have trumped that correlation and relationship. But also, I think it's interesting because probably it means to me a lot of investors, like more macro sort of institutional investors, have left, right? Which means that correlation is just down. I'd love to get your guys' kind of thoughts about how important is this connection to liquidity and connection with macro, and how much does that inform what's going on in crypto like now, and how much do you see it informing what's going to happen to crypto in 2023?
Yeah, I mean, I think when you go back and look at the inception of Bitcoin, it was created as a check on central banks, right? And that doesn't necessarily mean inflation. And so I think like over the last 2 to 3 years, you've obviously had this huge narrative that took off for Bitcoin in terms of being digital gold and this inflation hedge. I think the more kind of accurate representation, as we've kind of described through some of these correlations over the last 5-10 minutes, is, I would say Bitcoin is a monetary debasement hedge and not a CPI inflation hedge. And maybe that sounds like cope to some of the Bitcoin skeptics out there, but I think it's an important nuance to be made, because CPI inflation tends to lag when the liquidity actually comes into the system, right? And so you had 40% of all the dollars in creation that ever existed that were created at the beginning of 2020 in the response to COVID. And Bitcoin reacted the quickest, off that liquidity injection. And, you had Paul Tudor Jones come out with his whole fastest horse, thesis. And, I think you had an overlap period where, liquidity was still coming into the system and, starting to finally get reflected in CPI. I think it was one of those things where people were looking at correlation and not causation in terms of, Bitcoin trading a certain way because of CPI. I would say, as you described, Bitcoin's kind of sniffed out Fed policy before it's even taken place. Again, it was the first thing to react the most aggressively off of the lows and after the COVID crash. And then, more interestingly, I think it was the first asset to really correct aggressively as soon as, I think the Bitcoin top, this is a fun fact, the Bitcoin top at 69K was the same day that Powell came out and said that they no longer viewed inflation as transitory. And so I think that's kind of a good reflection of, exactly, Bitcoin serving the purpose that it's meant to be, which is basically serving as a check on central bank monetary policy.
Yeah, I kind of agree there. Obviously we've had two kind of negative catalysts in the Luna implosion, the FTX implosion, where I think it happened both times during kind of a short squeeze rally in global risk assets equities, right? So like we got the decoupling, it was to the downside. And I think some of we finally got it, guys. I think it is a liquidity game. Also, it's just like, I think a lot of the performance in hindsight, right? Hindsight is 2020, but if we just think of like, the explosion of DeFi, right? And then specifically kind of the excessive leverage that was put on across the crypto ecosystem in the form of like, people thought whether it was like, 15% annualized futures basis or like 10, 15, 20% DeFi yields, right? Like all of this was kind of like the same few $1 billion of stable coins and money.
45% the peak in 2021.
Yeah, it was nuts, right? And so, and then, come to find out that like you have like Alex Mashinsky, right? Like the DeFi ecosystem is very transparent, but then you have like the Celsiuses of the world and like, the Voyagers of the world and all these guys like, doing unsecured lending or like punting their user funds into like these farms. And so like that was like the hidden part of all the leverage. So I think the correlations still persist. We'll see that in the future. And Michael, like we talked on Monday, and the shoddy Wi-Fi kind of the scrapped our recording. We got rugged, but we talked about that correlation into the future, and I don't think it's necessarily a bad thing. Like people always talk about like, oh, Bitcoin should be this uncorrelated thing. It's like, well, no. I think if you want to think about Bitcoin like winning, right? Like if you think about Bitcoin, like the Bitcoin thesis, the Bitcoiners, if Bitcoin is a global reserve asset, never mind like the unit of account global reserve currency, like we don't even have to go that far out. Just like if Bitcoin wins, it's digital gold. And I know that for some people, that's like the bear thesis, which is fine. Like, I somewhat agree that it can be much, much more than a $5-10 trillion asset. That's, the equivalent of like, you just kind of store it in your vault and leave it there. But even if it's just that, right? Like $10 trillion asset, well, that means that it's somewhat monetized. That's a 30x from here at a $300 billion market cap. And that means it's monetized on the balance sheet of the globe. And so if you're thinking about like this dollar short squeeze, like we talked about, there's $100 trillion, $200 trillion of dollar short positions out there, a forced buying of dollars. And then you think about the asset side of the balance sheet where you have equities, bonds, bonds are, I guess, one person's asset, another person's liability, Bitcoin, right? Like they're going to be correlated. And I think that's a good thing. So maybe the correlation isn't very strong now. There's somewhat of an apathy out there in terms of like the lowest ever historical volatility, the lowest ever implied volatility. There's not many market participants out there. It's like you kind of have the DCA crowd, and that's basically it, right? Like there's not many forced sellers here. It's just it's just like if you're just looking at the log chart, it just looks like everyone's left, and I think that's indicative of everyone leaving. So we'll see when the next like kind of like hyper volatile cycle begins, or not cycle, but hyper volatile period. But right now, I think we're at that consolidation period of like, okay, yeah, all the bodies washed ashore. Only the convicted remain, but there's not all the billionaires or the crypto native funds that are chucking money on the table because they all got wiped, right? So we got some time. I think we get to watch this economic cycle play out, and maybe there's more downside catalysts in general in terms of risk assets, which I would have a hard time believing that like Bitcoin and crypto are suddenly like immune to, just being like objective. But yeah, I think the correlation will persist in the future, and given the lack of, or like maybe the relative illiquidity of Bitcoin and crypto broadly, like I would expect during the next upcycle, during the kind of recovery, that volatility remains to the upside. And so I think that's somewhat of a bull case during the next kind of liquidity upcycle.
Yeah, I think just to riff off that as well, like, I think kind of to summarize what Dylan just said is all the momentum buyers are gone, and the only, current buyers, at least at Bitcoin, are primarily value buyers. And, there's several, at least, from like an on-chain data perspective. Dylan and I post a lot of these charts on Twitter of all these different valuation metrics. We could run through like 5 or 10 of them, but I think just the super high level takeaway is, at least on a historical basis, and again, Bitcoin hasn't existed in a period of monetary tightening, but at least on a historical basis, Bitcoin is extremely undervalued. And also to Dylan's point as well, a lot of the tourists are gone, right? And we think about these people who just come in during the bull market, they check out and then come back in at the next all-time high. And when we look at active addresses, for example, on Bitcoin, this is one of the metrics that I always like to go back and look at. It's a very bare bones metric. It's not very fancy, but it also tells a very important story. When you go back and look historically, obviously the number of active addresses ramp up in a bull market. You have a bunch of people who all of a sudden want to buy Bitcoin because it's going up only, and broader crypto assets as well. But as we head into the bear market, yes, the active addresses decline, but the more important, the kind of signal in this is every single bear market, the number of active addresses makes a higher low. And we still haven't made a higher low in active addresses at the moment on Bitcoin. And I think that's just a reflection of, every single cycle you have, these new market participants, new network users that come in. A lot of those people do leave because they perhaps, don't really fully take the time to grok Bitcoin and understand the value proposition. But an increasing amount of people do every single time. And I think that's kind of the signal in the noise.
Hello, everyone. Thank you all for listening to On the Margin. Just wanted to give you guys a heads up about a conference that we have coming up in the new year called Permissionless. I'm sure most of you have been there last year. It is the cultural event of the year. We had over 5,500 people down in Palm Beach. This year, we are moving to Austin, Texas. You know what they say about Texas? Everything's bigger in Texas. So last year we had a really great lineup of speakers. We had the 2 co-founders of Robinhood, Vlad Tenev and Baiju Bot. We had Chris Dixon. We had some of the folks that have been on the show a whole bunch of times, Jim Bianco, Dan Tapiero. Just a phenomenal lineup of speakers, and you can expect the same this year. If you use Margin 10, you will get 10% off on a ticket. Again, that's Margin 10, because I love you guys so much. Click the link at the bottom of the show notes. Hope to see you there in person. Yeah, I would agree with you. Maybe we can start to group a couple of like buckets within sort of Bitcoin and crypto, which is sort of Bitcoin, and I'll include like miners there. I know, Will, you were starting to get into that, so I'd love to get your thoughts on that. Then maybe we could talk a little bit about like ETH and sort of ETH scaling, right? Like layer 2s and ZKs getting a lot of attention. And then like everything else, right? Which has been basically like, let's call that like the Solana, AVAX, sort of Cosmos, like alternative layer 1 thing. One thing, while we're still on the subject of Bitcoin here, I've sort of waffled a little bit on this myself, right? The narrative of Bitcoin is a hedge against inflation. On the one hand, right, I understand that's been like popularly maligned, but I'm not actually sure if that's fair because, for 2 reasons. So one, if you look at gold trades inversely correlated to real rates, right? And it's actually the more accurate way of saying that is it trades inversely correlated to the expectation of real rates. So if you go back to the 70s when there was rampant inflation, gold wasn't ripping when inflation was peaking because the thought process was at that time, real rates are already so negative, there's only room to the upside, basically. So the move sort of happens before, right? Markets are forward looking, including expectations on rates and real rates. the other thing is, if you think about what a hedge is supposed to be, it's insurance, right? So if you think about insurance from the perspective of like, you get your house insured in case it goes up on, in case it gets lit on fire, then if you buy the insurance before your house gets lit on fire, then it's going to be a plus EV purchase, right? But if your house is on fire and then you're like, I want to buy insurance for my home, it's not going to protect you against anything, right? Because the cost of the insurance is going to be more than the home. So that would be sort of my critique, right? It's like, if you view Bitcoin as a hedge and you buy it as like an insurance policy based on central banks debasing or rampant inflation or whatever, you have to buy it before it happens. Obviously, if you bought it after the threat materializes, it's not going to save you from much. I'd be curious what you guys, I think the inflation hedge narrative has gotten maligned, but I kind of waffle back and forth on whether or not that's fair as a critique or not.
Yeah, I mean, Will said it best, 10 minutes ago, in terms of like, yeah, people think of like, people incorrectly were like, Bitcoin's a year-over-year CPI hedge, which it's not. It's like, I mean, really, every asset on the planet is just flows, right? Like, there are fundamentals to an asset, but the traditional value investor, the reason that so many macro people that are like, otherwise, that agree with the Bitcoin, or the broad-based Bitcoiner thesis, right? Like the Brent Johnsons of the world, or the Mike Greens of the world, who like I actually love listening to and hearing their in-depth analysis on things. But they say, like I don't get the whole Bitcoin thing, and that's fine, right? Like that's what you want in markets. But like, because what are the fundamentals of Bitcoin? There's no cash flow. There's no earnings, right? So like the traditional value investor is like, what the hell is this thing? It's just a liquidity gauge. And then I would say, yeah, it is a liquidity gauge. Exactly. Right. And it's just marginal buyers and marginal sellers that's any asset. It's just flows. And here we have an absolutely scarce thing. And so the supply and elasticity of it works both ways. One of the things that I probably put a little bit too much weight into was that like the on-chain data during the second double pump was extremely strong, right? Like there like the free float was extremely constrained. It was like, oh gosh, like this thing might actually just like mega rip even further past these all-time highs. And what was wrong was that all it took was a small amount of sellers on the margin, even though the thing is so inelastic. There's 80% of the float doesn't even touch the market, but the price lost 80%. Like, how did that happen? And it happened just because the supply and elasticity, similar to like oil in a way, right? Where like just a marginal change in like a couple million barrels of production, right? Like maybe of SPR releases, or Russia goes offline and oil rips, right? Or like if you just look at say like maybe 2008, right, where oil rips and then crashes by 80%, right? Like the marginal supply of oil didn't actually change all that much. The marginal demand barely changed, but the price rapidly changed. It's like Bitcoin is similar. It's not a direct comparison or maybe the best analogy, but I think that's how I think about it. It's a game of marginal flows, marginal buyers and marginal sellers. And what has me, perma bullish on Bitcoin for the long term, not next week, not next month, not this quarter, not that I'm like overly bearish at 17K. I'm not, massively leveraged short Bitcoin here. Like that's not what I'm saying. What I'm saying is that I know that Bitcoin will never have more than 21 million because I run the software, I run a node, and I can guarantee that for myself. And I also know that there's a growing amount of price agnostic buyers of this asset over the long term. And so regardless of what happens this quarter or this year, I know that crazy group of Bitcoiners with laser eyes that are mean to you on Twitter are ultimately just like buying this thing and never selling it. And so when the flows return, whether it's liquidity or whether it's a new group of buyers come in, sovereign wealth fund or whatever, like the narrative has changed over the course of Bitcoin, and we've seen the narrative arise and then get crushed when the price goes down 80%, but it's never died, right? Like Mt. Gox was the only exchange on the planet. It collapsed. Bitcoin didn't die. Like, how did it not die? Well, because like there was that, intolerant minority of hodlers that were like, no, like I'm going to buy this thing. I'm not going to sell it. I don't care. And so regardless of how low it goes, like I'm uber confident that the exchange rate will recover. I don't know how long it takes. But I know that on one hand, we have that story. And on the other hand, we have the story that just by the nature of the system of credit expansion in a fiat monetary system, there needs to be an ever expanding money supply. There needs to be an ever expanding supply of credit in the system. And so on those two things, right, like numerator, denominator, over the long term, I see no other reason but to be bullish on a fixed supply asset that no one can manipulate that has a rising marginal production cost. Like I think that's the thesis, and it's widely misunderstood, and people often misinterpret or confuse the timeline of that thesis. They're like, haha, like Bitcoin's down 70%, like it wasn't an inflation hedge after all. And it's like, well, yeah, Bitcoin started 2020 at 6K, right? Like, so like, I mean, it's worked out, right? Like, obviously there's a class of buyers that are underwater, but this happens literally every cycle. Like the average Bitcoin holder is underwater literally every bear market. It's happened 3 or 4 times. So the story is unchanged. And I think that's just like the most challenging, but also the most fun thing to communicate is like, guys, this literally nothing has changed. It's just you can buy 4x more than you could when everybody loved the thesis.
Yeah, and I think you could see that in the data, exactly what Dylan's saying. And you can look at several things, no matter how nuanced you want to get, even just looking at something as simple as the amount of Bitcoin supply that hasn't moved in a year. That's right near all-time highs, I believe, at 67 or 68%. You can look at something that Glassnode, which is the on-chain data provider that Dylan and I both primarily use. You can look at something called long-term holder supply, which is defined as an on-chain entity that's held their Bitcoin for at least 155 days. Long-term holder supply is near all-time highs. And then, to kind of highlight also Dylan's point about, people kind of, holding their Bitcoin down with an extreme amount of conviction. When we look at the percentage of Bitcoin supply that's underwater, held by long-term holders, that's also at an all-time high. So, however you want to slice it, there's absolutely a hardcore group of individuals out there that are going to continue stacking Bitcoin no matter what the price. And I think that group of individuals understands that kind of the year-over-year change in the exchange rate has nothing to do with the underlying fundamental thesis for the asset over the next 5, 10 plus years.
Well, you're starting to get a little bit into the mining dynamic. For those there are probably some viewers of the show who don't really understand the way kind of mining versus Bitcoin price kind of work, and you were talking about miner capitulation, which tends to mark the bottom of these sorts of crypto cycles. Alicio, can you describe a little bit about the relationship of mining and price of Bitcoin, and then also sort of your thesis on how much that's the tail that's wagging the dog, so to speak?
Yeah, absolutely. Just from like a super first principles basis, when you think about what are the kind of variables that go into being a successful Bitcoin miner? Miners are essentially long Bitcoin spot price. They're short energy costs, and then they're also short hash rate, right? Given that hash rate is basically a reflection of the competition to mine on the network. And so, over time, it becomes increasingly difficult to mine BTC. And we can look at something called hash price, which looks at miner revenues and hash rate to basically get price per terahash. And that perpetually, declines over time as more people mine Bitcoin. So you already, Bitcoin mining already is a very competitive industry to get into to start. But this year has been particularly difficult for miners. And the reason behind this is because when we look at global energy prices, they're up across the board. So if you don't have, fixed energy contracts as a miner, your margins are getting squeezed by that. Also, the underlying Bitcoin that you're mining, the exchange rate of that is down 80%. And then lastly, we've seen hash rate continue to rip throughout the year. So we've seen this continued squeeze on miner margins throughout the entire year. And I would argue that it's probably been the most difficult time period for miners over the last 12 months. And we've seen that reflected in, firms such as, well, first of all, just in the, stock prices of, all the Bitcoin miners, which is partially just them trading as like higher beta to Bitcoin spot, but, in large portion because their margins are getting compressed. But we've seen several firms either have to sell the majority of their Bitcoin holdings, a lot of the public miners having to trim a large portion of their Bitcoin holdings. The most notable one was Core Scientific, partially because they had a large amount of debt. When we look at debt to assets, debt to equity, Core Scientific was by far the largest debt holder of all the public miners. I'd also throw in there that Riot has the lowest amount of debt out of any public miner that's out there. Riot also has fixed energy contracts with the state of Texas. So I think, out of all again, disclosure, I don't own any Riot, neither does any of the Reflexivity team. But I think, someone like a Riot who has some of the components that I just described is probably one of the better firms out there that are, kind of, situated to kind of weather the storm. And I think, I think, you'll probably see over time, a lot of people are saying, yes, this is, if this is such a bad time to be mining, why do you feel like, hash rate will trend up over time? I would say, first of all, if you're bullish on Bitcoin, over a 5, 10+ year time horizon, it's almost, always a good time to at least, get involved in mining to some extent. But I think, you'll have more energy producers that, have excess energy that they otherwise would be wasting. They're able to leverage that to, mine Bitcoin and basically generate revenue in a way that they weren't previously able to. I think one really interesting example of this is the Great American Mining Company. This was something that I heard from a podcast that Marty Bent did, who's one of the kind of Bitcoin thought leaders. Basically, what they do is they go out into there's like I forget exactly what the Dylan, maybe you know this, but what exactly the firm did that was mining like physical like rocks out in like the middle of the desert or something in the Midwest, and they have to flare off the excess energy that they're not using. And there's obviously like environmental restrictions on how much they can flare off into the atmosphere, and they get surveilled on that, and so therefore they're not able to operate 24/7. Now, what the Great American Mining Company does is they come out with essentially these containers. They bring them out. They can bring them out anywhere as long as they have access to power and tap into the Bitcoin network anywhere. And they say to these guys, okay, look, if you give us dirt cheap energy, or even in some cases give us this energy for free, we'll come in and utilize that. So it's a win-win for both parties, right? Because on one hand, the miner is able to get access to near free energy costs, and then at the same time, the physical miner who's had to flare off the energy otherwise is now able to operate for a longer period of time and increase their revenue as well. So I think you'll see more things like that. You also have seen things like Exxon and Shell kind of hinting at at least showing interest in potentially getting involved in Bitcoin mining. And so I think like if you think over a long time horizon, I guess if you look at the percentage share of hash rate over time, and what's made up as, I guess I would frame it as like passive hash rate versus kind of active, Bitcoin mining operations that are solely launched, to a business that's launched, say, hey, look, like we're going to go out and mine Bitcoin. I think you'll probably see a larger percentage of hash rate be made up by these quote unquote like passive mining operations that just have, dirt cheap energy.
Yeah, I think I agree there. The commoditization of ASICs, I think, is real. I don't think in 10 years you're going to have large scale commercial operations that are just plugged into the grid with the sole purpose of mining. Potentially, or at least like in a like near like what we're seeing in Texas, right? Like where all these miners come in, they're on the ERCOT grid. And basically they have fixed power contracts, and they agree to sell some of that energy back to the grid during kind of peak baseload demand. I think that's a sustainable business model. But in terms of like the miner equity price, right? Like we saw these miners were just like levered beta on Bitcoin. They were leveraged against Bitcoin. They all had kind of HODL strategies. 20 public miners that got access to public financing. That all levered up. Like I kind of think of, I have a basic framework, and Will referred to it earlier, like hash price, miner revenue per terahash divided by, or miner revenue per terahash, right? Miner revenue in Bitcoin terms or dollar terms divided by hash rate. You can kind of standardize that. Miners, if you're buying a miner, right, like ultimately your goal should be to outperform Bitcoin. That should be your benchmark. Otherwise, like just buy Bitcoin. If you look at like the hash price cycles, when hash price is increasing or hash price is decreasing, and when hash price is increasing, the miner margins and profitability are increasing. Basically, like the simple framework is miners outperform Bitcoin when hash price is increasing, and they vastly underperform Bitcoin when hash price is decreasing. So I think it's actually a really interesting strategy to, and I've done some of this personally, like use miners as both a tool for outperformance and somewhat of a hedge during these bear market cycles when, we know post China miner ban, post 2020, 2021 kind of bubble, there's a lag time in terms of all of these new rigs that got produced, that got manufactured coming online. Rack space, that like these things take time, and there's a lot of physical infrastructure that has to be built out. And so regardless of what the Bitcoin price is doing, if the Bitcoin price is just stagnating, and we see hash rate pumping to new highs, right? Like that's bearish for miners. That's bearish for miners in Bitcoin terms. So I think it's like, we'll see what happens next cycle, and we'll see how many, public miners we have, or whether we have a lot of standalone companies like Will was saying, or we have much more of like the integration with energy markets, right? Where, Shell has a mining operation and Exxon has a mining operation. And like, we should preface this with saying that mining is still, the Bitcoin mining industry is still tiny. It's extremely tiny. It's like, $20 million of revenue a day at this point, 900 BTC times, 17K. It's not even 20 million a day. It's less than that. It's like 16 million a day. And that's revenue. It's not even profits, right? So for an Exxon, for a Shell, that's like, couch, change under the couch cushion. So like, I think it's a really opportune time for these energy producers to come in, to scoop up some cheap ASICs, maybe to acquire some mining firms, and repurpose this and integrate it with their operations. So we'll see what happens. I think it's pretty phenomenal to watch Bitcoin hash rate, like on a 14-day moving average basis. It's made new highs today, right? So all-time highs. That's pretty nuts when you think about Bitcoin being down 75% from its highs. And that's just kind of another piece of the story when I say, the macro people misunderstand what's happening here. That's just kind of another thing I look to, is like, okay, if this thing is dead, why are under the surface hash rate going to new highs? Why is hash rate, like Bitcoin was $20,000 in 2017, and some of the skeptics will be like, you see, like it's gone sideways for 5 years, 6 years, and I'll be like, yeah, and hash rate was 3x a hash, and now it's 300. Like,
And
what do you
that
think is
energy
going on here?
cost is very ingrained, I think, into the price of Bitcoin. It's hard to kind of standardize what exactly, the kind of aggregated, cost to produce a Bitcoin is, because there's several variables at play there. Some people have tried to do it. For example, Charles Edwards from Capriol Investments, you can go on TradingView and type in, I think it's production cost as the indicator, and you can see what and he's described his thought process for, putting the indicator together. And he's got it at like, I think around 15 to 17K as production cost. But, at least with looking at that indicator, which I don't think is a perfect representation, again, because, so many different miners have, different variable input costs. But, you see that price does very much interact with that. And I think, from like a first principles basis, it's because, if you're a miner, you're going to want to sell Bitcoin for more than what you produce it for, right? And so I think from Bitcoin's inception, I mean, the very first exchange rate for Bitcoin was based on the cost to produce it on your laptop. So, I think over time, if solely you agree with what Dylan and I are saying, that, it makes sense for, energy producers to utilize Bitcoin mining in some capacity, and you think, a $20 million revenue a day industry is likely to grow, 5x from here. That in itself should, from a first principles basis, over time bring up Bitcoin's price as well.
I've got a question actually. If you get, one of the interesting things about miners, I think in basically any sector of crypto, there's more public stock miners, right, than just about any other category. Most public crypto equities are getting absolutely smashed right now. So like Coinbase is completely in the gutter. I want to talk to you guys about Silvergate. Dylan, I know you've been tweeting a lot about the whole situation that's going on over there. I personally think a lot of people, because of this whole idea that you can't value Bitcoin, right? I've got no cash flows here, so I can't get comfortable with Bitcoin, but what I'm going to get comfortable with is a company that produces cash flows, even if it's entirely based on Bitcoin or crypto as an ecosystem like Coinbase, right? So if you actually looked at most public crypto equities, they outperformed on the way up, right? They actually did, in terms of price appreciation, MicroStrategy, Coinbase, Voyager, RIP, Galaxy, Silvergate, whatever it was, it did better on the way up, but now they're getting absolutely smoked on the way down. And I think there was kind of a hidden premium there because a lot of public market investors wanted exposure to crypto. So that's why it outperformed on the way up, then it's gotten extracted on the way down. So it's just like, basically you could almost think about it as like the grayscale premium. It's just less visible. So it's a premium, and now it's turned into a discount. I'd be curious though, just because there's still a couple of overhangs in our industry, right? So Silvergate, I don't know if you'd call that an overhang. It's certainly something that people are worried about. And then there's this whole ongoing situation with DCG versus Gemini. I'd be curious what both of you guys think about those two situations.
Yeah, who knows what happens with DCG? It looks, the Winklevoss twins, and I'm not a legal, I'm not legal advice. I'm not really, I don't have the authority to speak on some of these things, but just my 2 cents is that, they claimed fraud, right? So that's a bold claim. We'll see if that is. There's certainly some interesting things to look at as GBTC is is a SEC regulated product. They've applied for all these ETFs and things and have gotten declined, but we could say maybe there was a lack of disclosure. There was some funny accounting with the promissory note that happened post Luna collapse. I don't know the specifics on the Gemini Iron thing and all of that. I mean, I just know what's public. But there's, I think similar to most of the year, right? There's like the overhang is that there is balance sheet impairment and there's underwater equity assets leverage, right? So how does that get resolved? I think there's a tail risk that, and I don't think this is highly probable. I think there's a tail risk that the trust is liquidated. I don't know how to quantify that probability, but I think there's whether that's SEC enforcement. I know there's some activist campaigns going on. David Bailey is leading that with redeemgbtc.com in terms of just coordinating shareholders together. And there's not a certain angle that's being taken yet, but more so and just personally, I can attest to there being some significant institutional investors that from TradFi and in crypto that everybody would know the names of that are privately signaling their support for kind of an activist campaign. So we'll see what comes of that. I certainly don't know. And that is probably dependent on what Gary Gensler says, honestly, and potentially any charges that DCG faces. So yeah, I think that's one thing to resolve. Silvergate's interesting. We'll see if they continue to get run for their deposits, but I think all of this is just pointing to I like to have a very basic framework of okay, is this a net benefit or a detriment to liquidity into the future? And Silvergate was obviously a very big dollar off ramp and on ramp, right? So if Silvergate, I don't think they necessarily go under or not, but that's obviously the name's been killed, right? And certainly there's some interesting AML money laundering things to look at in terms of the FTX Alameda bank account situation. So I'm not a bank analyst. I there's a lot of things that I can't speak on, but I think there are some we've gotten rid of most of the significant headwinds, but I think there's still potentially some headwinds that remain, and we don't quite have the wind at our back yet.
I think on Silvergate, one important thing to state is that any loan exposure that they have is all Bitcoin only and over collateralized. So, for example, if you think about the structure of MicroStrategy's Bitcoin loan that they took out earlier this year, they also hold no crypto on their balance sheet. So, I think in terms of people were getting very concerned about contagion, after the FTX blow up. I don't think in terms of direct credit exposure that's necessarily a concern. It's more about you've seen, 8 billion in withdrawals from Silvergate over a very short time period. And, that causes them to have to liquidate some of the securities that they're holding as reserve assets and potentially taking hits on those as they're liquidating them. I think, as Dylan also touched on, the other thing to be concerned about with Silvergate, and again, I'm not a legal expert or banking analyst either to make any of these claims, but I think something that I would watch out for people that are is concerns around potentially essentially facilitating money laundering and fraudulent activity between Alameda and FTX. Whereas you've heard multiple anecdotal stories where people basically wired money to FTX and it went directly to Alameda bank accounts, and Silvergate was kind of at the heart of between those things. On the DCG stuff, I think Dylan pretty much hit on everything. I would say I don't think there's outright fraud going on at DCG in the same way that was with something like Alameda or FTX, just because it's been so long, and I think people would have sniffed that out by now. I do think people need to keep in mind that Barry has a bankruptcy restructuring background, so I think he's probably very carefully, methodically thinking about potential options, and they do have several assets. I don't think that they'd be able to get the value out of them that they maybe could have even 6 months ago, because people know that they're under some degree of distress. Even something like a Grayscale, right, which I think brought in there was 700 million in revenue in 2021 and something like 200 to 300 million last year with Bitcoin spot price. It depends how you calculate it, right? Maybe if you did like a VWAP for the year or something like that. But nonetheless, multi nine figure, several $100 million business. I think it depends on the multiple you put on that as well. But there's definitely value there, and that's kind of like their crown jewel. And then they also have, a portfolio of different investments, that they're like either a partial or outright owner in. And they also hold a bunch of, crypto venture capital investments, which I don't think by any means they'd be able to get the mark-to-market value of if they actually, needed to liquidate them. I do think though they have a substantial, asset base that they could potentially, utilize to do some type of restructuring if they needed to. So, I don't think in terms of some concerns around, outright fraud taking place at DCG, I don't think that's the case. I would say one person to listen to on the DCG stuff, and Dylan, I'm going to ask you for this guy's name, Ram, and I forget his last name, but he's like a TradFi guy who's kind of got involved in crypto. He just recently did a podcast yesterday on Unchained. I would say just type in probably Ram on Twitter. You'll be able to find the guy. He's brilliant. Dylan, you're on mute.
All right.
Yeah, I'm not sure how to say his last name. Ram, AHLUWALIA.
Yeah, that's the guy.
Aluwalia. That actually sounds a little familiar.
He's been covering it pretty well.
Nice. All right, guys. I want to get your sort of general thoughts, and maybe we could try to be quantitative about this. I'll just give you like the way I sort of feel about this thing, like going to 2023. The big question that I'm trying to kind of mull over, and I'd love to get both of your opinions on, is do we need to see some sort of inflection or pivot? I don't want to say pivot because it's such an overused phrase, but like a change in monetary accommodation that's initiated by the Fed in order for things to reverse in crypto. Some we were talking about when Blockworks got founded, and that was founded in, called the top of like December 2017 is when we incorporated. So we saw a lot of bear market activity, but this reminds me of a period of time. Like I feel like I've lived through something like this before where, there was a point where about a year into prices just falling, there's just like not a bullish thought in sight, right? I mean, it's like all right. There are all these overhangs, and back then the story was different. It was like there's a big narrative about like high watermarks and how all these funds were never going to reach the high watermarks, and therefore they were going to have to capitulate and sell. And there was this overhang. There were like different narratives back then. But if you look actually back at that time period, this is overly simplified, but the fractal basically going forward from January of 2019 is sort of up only, right? And the sentiment was still very negative, and it was still definitely a bear market, and there was an enormous amount of activity. But the worst in terms of sort of the fallout phase of the bear market was kind of behind us. So, I struggle because on the one hand, I understand the overhangs. I see the headwinds that we've got going into this new year, but a little part of me, maybe based almost on muscle memory more than anything else, is slightly positive and optimistic going into the new year. I'd be curious if you guys feel the same. Do you think, positive, negative going to the new year? And if positive, like what's something you're excited about? I guess what's something that kind of jazzes you up, or opportunity you see, or a trend that you're paying a lot of attention to?
Yeah, I mean, if you think about 2019, like what really drove the move from 3K to 14K, some people say that the plus token Chinese Ponzi played a part in driving like underlying spot flows, but the majority of that run up was just a massive short squeeze. And so, you can look at things like funding rates and open interest to kind of gauge, whether shorts are coming, piling into the market or not. Something that we haven't seen quite yet in terms of like a very clear like regime of negative funding rates, indicating that like a ton of shorts are piling in. But we have seen, at least in altcoins, over the last week or so, a bunch of these like heavily shorted protocols such as, Solana, or a lot of like the Barry Silbert DCG coins, going under these massive short squeezes. We also saw that with Lido, people like basically shorting it the whole way up. And then we saw like a 50% 15-minute candle a couple days ago. And so I think, it's just a small glimpse in terms of what can happen in like a high time frame sense of, if you have people continuing to, short the market and expect that there's more dominoes to fall, that in itself can be a catalyst. And then, the more, I guess, the more shorts that are in the market, the less, underlying spot flows you need to kind of trigger some type of momentum. And then, you can have, momentum buyers step in. So I'm not saying that will happen, but like that's a dynamic that played out that drove the 2019 move from 6K to 14K. And it's something that like I would continue to watch for is the underlying derivatives data. I also think, what essentially you just described, Michael, is you kind of have these like two forces that are pushing against each other. On one hand, you have kind of this macro overhang and, a lot of people, probably rightfully so, expecting another kind of leg down because of kind of the broader macro conditions. But then, I think also underneath the surface, Particularly I would say in kind of the, non-Bitcoin crypto specific stuff, there's been a lot of developments, at least I personally think have kind of gone unnoticed. And then also Bitcoin native. I mean, I'm just scrolling through this list that we put together. Fidelity offering Bitcoin and ETH trading, Fidelity offering Bitcoin and retirement accounts, BlackRock announcing Bitcoin support in Aladdin for their private clients, which, keep in mind, they're not going to do these things if they don't have underlying demand from their clients to do so. Because, they know if they don't offer it, they're going to go to the next place that does. BNY Mellon offering crypto custody, which is the oldest bank in the United States. The NASDAQ offering crypto custody. This is another interesting one, I think, that maybe wasn't given as much attention as it could have been, is Starbucks using NFTs for their crypto rewards program, which
I agree with this.
Starbucks, and this is something you guys talked about on the Bell Curve pod, is Starbucks has the largest rewards program in the world, and the fact that they're now integrating with NFTs, I think that's super interesting. And then the most recent one was Visa integrating payments using Starknet, and so I think there's been a lot of kind of underlying developments going, on underneath the surface, and I think developers kind of had their heads down. And so I think when you think about, and also on the Bitcoin side too, I think there's a lot of kind of infrastructural developments. A lot of that gets overlooked because I think, the Bitcoin native, ecosystem projects aren't as sexy. But I think I just did a report on some of the venture capital investment in crypto. And Bitcoin specifically, I did a whole section on that. And, I think we're really kind of getting the piping and plumbing in place for, the next kind of bull run. And so I think you kind of have, on one hand, kind of the macro forces pushing down on the entire space. And at the same time, you have this underlying, development. And as we kind of described earlier, a lot of the market participants that were tourists are gone. And so I think that leaves at a minimum the conclusion that, the market will, maybe it's slightly down on the end of the year, but I kind of lean in the camp of at minimum will probably go sideways. I think there's a very low likelihood of another 70, 80%, down year for at least Bitcoin and Ethereum.
Let's hope. Yeah, no, I agree there. I think there's still the headwinds in the macro picture. The infrastructure piece that Will referred to is really key. I think, that's what we see in these bear markets, is that, the piping, the infrastructure gets built out. I think honestly, the wipeout of really every exchange and every firm and every player that did collapse, as bad as it may be, is very, very healthy. And honestly, it's probably what we want in terms of, it would be a disaster, right, if FTX didn't collapse, if they integrated, with US commodities and did all their lobbying efforts and got to 2027 or 2025 or whatever, you know what I mean? And all of a sudden, instead of 10 billion in deposits, it's 170 billion, and they have equity futures and, CME, like they're a CME competitor. Imagine that, right? So I think that's kind of how I view it, is we want the Fidelities of the world and the, XYZ legacy institution of the world to have Bitcoin offerings instead of, the Celsius of the world and, similar companies of the like. So that, I think that's just what I'm looking for. It's just the kind of under the surface growth, hash rate continuing to chug. I think the exchange rate at the moment is probably the least interesting aspect of it, just considering there's no volatility. We know the story, and we know that the USD aspect of this BTC USD exchange rate is probably the preliminary driver for the time being. And I think, we're setting the groundwork for whether it's 2024, whether it's the halving, whether it's, a change in liquidity cycle. A lot of these things are somewhat hard to predict. It's all probabilistic. But I think, really just kind of laying the groundwork for kind of the next wave of adoption and kind of the education component. I know that's very cliche, but even among participants in the industry per se, or people that may or may not have had Bitcoin exposure, there's just an education gap of what this thing actually is doing.
1,000%. You're preaching to the choir. Thank you for allowing me to sell my own book here at the end. But yeah, the education, there's still an enormous amount of work. And honestly, there's the anecdote of Saylor educating his board through YouTube videos is like a hysterical, but still rings very true even today, right? I mean, that's like the best way you could educate your board about an entire, $500 million initial buy and pivot in your entire strategy is beyond wild to me as CEO of a public company. So a lot of wood to chop, but also I think that's exciting as well. And also if you're like building a business in this space as well, during this period of time, it's not as easy to go out there and find and generate revenue, but it's there's much less noise, and you're getting a lot less false signal about ways to like direct your business. And then also, I mean, I'm sure there's an analogy for both of you guys as well, but like there are lots of incumbents that decide, oh, we need to have a crypto plan. They throw a whole bunch of money in. It's very difficult to compete. And then there was never any real buy-in. So they all like, pull it back during this period of time. So I mentally categorize these periods of time as like runway. We've got like 1.5 years or whatever left to like really sprint and build before you kind of surf the wave in the bull market. So guys, again, just huge credit to both of you guys. You guys are some of the sharpest analysts in the space. I really appreciate both of you guys coming on. I want to give you both the chance to plug some of the great work that you do. Maybe whoever wants to go first, like what's the best way to follow you, find out more about your work?
First off, thanks for having us. This was it was great to connect. Big fan of what you guys are building over at Blockworks. I listened to this podcast. I listened to Jack's podcast. You guys are putting out some great stuff. As in where you can find me, I'm on Twitter at Dylan LeClair _, writing some stuff with Bitcoin Magazine Pro. So we cover a lot of this stuff that we talked about, kind of a data driven outlook, but covering kind of all things Bitcoin and macro. So that's where you can find me. And yeah, it was a good chat.
Yeah, thanks so much for having us on. We were talking about the informational gap. I think if you and Jason keep doing 25 different podcasts, then we might be able to close that gap. So chugging along, man. You're doing God's work for us all. But yeah, I mean, you can check out Reflexivity at reflexivityresearch.com. We cover everything from Bitcoin native stuff, Ethereum, DeFi. We even do a little bit of NFTs sometimes as well. Basically everything that we feel like you need to know about crypto. We do everything from multiple reports every week. We do weekly analyst calls, and we also have recently done some collaboration with Blockworks as well. We have a upcoming. I don't know when this will get uploaded, but we have
this is going to go live tomorrow. So we should plug this actually at 5 p.m. today if you're listening. Right? It'll be. You guys got the spaces?
Absolutely.
Phenomenal, guys. Thank you so much for coming on the show. It's been a pleasure talking to both of you. We'll have to do it again sometime soon. Cheers.
Cheers, y'all.
Thanks, gents.